From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 9th, 2024. Checking the calendar, the Brewers are home all week with Cincinnati, Los Angeles, and Cleveland. It's a busy week at AmFam. State Fair is wrapping up this weekend, and the award for the longest name for an event goes to the 20th Annual Cheese Capital Jazz and Blues Crawl for the Arts. That's in Plymouth, Wisconsin. And one more, the Milwaukee Dragon Boat Festival at the Lakeshore Park is happening this Saturday. All right, here we go. A fully automated procedure using artificial intelligence and 3D imaging is now performing dental work. Call me old-fashioned, but I'm not about to let a robot stick sharp objects into my mouth, no matter how cute the hygienist is. And in the state of Pennsylvania, the Supreme Court has agreed to review a suicide ruling by the lower court. It involved the case of a woman found in her locked apartment. She was stabbed 20 times, and the lower court ruled it a suicide. I'm the forensic scientist, but I'm pretty sure she didn't trip and fall on her knife 20 times. And finally, India's biggest budget airline is trying out a new booking procedure. It's designed to keep women from having to sit next to men. That can't be good for members of the Mile High Club. On the podcast today, we have Adam Bailey, Joel Dresang, John Sandstrom, and wrapping up the week, here's Kyle Tedding.
As always, Max, so many questions on your open, but just impressed that you called it American Family Field instead of Miller Park. I still make that mistake.
What's not County Stadium?
Fair enough. Well, we can laugh despite the start to the week. It was a pretty rough Monday after what had been a pretty rough Friday last week, and yet on the week, NASDAQ down 31 points, 0.2%. The S&P down 2, not enough to move the needle in terms of percentages. And the Dow Jones Industrial Average down 239 points, down 0.6%. For the year, NASDAQ still up 12, the S&P up 12.9, and the Dow up 5.9, including dividends. You know, Adam, I would be remiss if I didn't start with the very fact that despite more volatility than we've seen in a while, especially on the S&P, basically starting where we finish, it's a pretty okay place to be in what was an otherwise kind of tough stretch for stocks.
Yeah, to consider where we started the week, very rough Monday. Market rallied throughout the rest of the week, and if you were just to look point to point, you'd be like, nothing happened. The S&P didn't even budge, and moreover than that, if you look just year to date, even after all the volatility we had this past week and a half, the S&P 500 is still up handily. The Dow Jones Industrial still up about 5%, more dividend payers there. And I think after all of the volatility we've seen this past couple of weeks, it's just a good reminder to maybe just take a pause and survey the landscape and just remember kind of where we are. And it all comes down to interest rates and earnings. Interest rates, 10-year Treasury as of this afternoon, 3.9%. Historically low borrowing costs for people and businesses, and that's good. We're starting corporate earnings season. Corporate earnings still look pretty good for the rest of this year, maybe up 10% for the full year. So even with all the volatility, some of the fundamentals are just adding a lot of stability underneath it, and maybe that could have been a cause for a decent rally that we've seen the second half of this week.
Yeah, I think refocus on those fundamentals, which is the core of what we do. Of course, it's impossible to ignore the technicals. John, you and I were joking before the show about the Monday spike in the VIX and how we had a moment where it was trading around 64, 65. It had been down around 12. And, it's a really wonky kind of technical, in the weeds kind of indicator. But the long and short is it really tells us what the expectation is for volatility. And I think so much of that expectation for volatility picking up was tied to some very technical issues. Friday, yeah, okay, you got a little bit of a sell-off. Those happen. But then over the weekend, we had this kind of, especially Sunday night into Monday morning, we had this kind of Japanese yen carry trade that started to pop up on a lot of news feeds. I think spooked some investors Monday. We always give our most junior advisors here the toughest questions on the podcast. So explain to us the yen carry trade.
Yeah, so pretty bizarre catalyst to move our markets down to start the week. But, basically what it boils down to is a lot of institutional investors, thought they had a carry trade with cheaper yen that had little to no risk, where they were borrowing yen to purchase assets. Essentially, that trade began to show a little bit of risk, started to crack a little bit and unravel. And as soon as that kind of trade starts to unravel, the only way to pay back all of that money that you borrowed is by selling assets. A lot of those assets were Japanese assets, and that kind of tanked their market. Down 12.5%, I think, definitely spooked other markets around the globe, which led to kind of a spillover, especially into our markets, which I think pre-market Monday we started down 6.5, and kind of moved from there.
I think a reminder that there's no such thing as a free lunch, right? Just that you think you can borrow cheap in one currency, turn around, invest it in another, and get a little bit more interest. Well, yeah, that works until it doesn't. And the knock-on effect of it not working, I think, caused all of us to feel a little bit of that pain Monday. A reminder, of course, that those technical things are going to have an impact short term.
And what I found interesting is what happened the next day after the Nikkei dropped 12.5%. What happened the next day? It was up 10+% the next day. And again, if you look point to point, it was almost a non-event. But it's also a reminder of sometimes the computer automated trading that goes on in the background, especially with the carry trade, where all of these computer systems had the same trigger points essentially on when to exit, and they all hit the eject button all at the same time. It added to a lot of volatility. Just be thankful you weren't a Japanese investor. Like on Monday and Tuesday, it was a volatile ride. But then again, the stability and sanity came back to the market later on in the week.
It's also a reminder, we had a podcast July 5th, I think it was, looking at how interglobal everything is, and some American investor minding their own business, with their money here was affected by that Japanese carry trade. So.
Yeah, the S&P down 3% on Monday. Again, largely technical. Tuesday and Wednesday, kind of wishy-washy days. Up a little Tuesday. We started the day Wednesday up pretty meaningful and gave it all back. And then Thursday, we got the best day we've seen in 2 years. And I think, Adam, this is something you and I talk about quite a bit. The difficulty in trying to time markets is that sometimes you miss the very best days because they come in such close proximity to some of those very worst days. Friday, Monday, all of a sudden, you get to Thursday of this week, and if you had been reacting to the bad news, overreacting to maybe some of that technical stuff, well, all of a sudden you got hit twice. Once because you participated in the down, and now twice because you didn't get the 2.5% pop that we saw on Thursday.
Yeah, and you can never react to stuff like this. And you mentioned how difficult it is to try to time the market. I'll rephrase. It's impossible to time the market. You can't do it. It's about time in the market, not trying to pick the days that are up or down. And as a reminder, the best up days, the biggest up days, always come after the biggest down days. And if you miss just a handful, 2 or 3, of those biggest up days over an entire market cycle, you essentially shoot yourself in the foot for your long-term returns. So you cannot give up during the volatility. You just got to have patience through it.
And I think the thing that helped us with that patience was the returns we've seen on bonds, in particular last week, but even this week, seeing some stability from our bonds. Yeah, rates moved a little higher. We gave a little of that gain back, but it's a strong reminder that this is not 22 anymore. This is an environment in which bonds actually have something to offer.
And that's what you want to see in today's environment where stocks sold off. Bonds rallied. Bonds had their day in the sun, and that's a normal, healthy market force that we did not see in 22, and everything was down in lockstep. But this time around, when stocks sold off, what you really wanted to have happen is bonds rally, and that's exactly how it played out this week.
And then a temporary, very small bump higher in junk spreads, right? In the rates that we expect to get paid to buy lower quality but higher yielding bonds. We anticipate that when you buy that lower quality, you should get paid more than you're getting paid to buy a treasury or a really high quality bond from a business that you're fairly confident is going to be around. when you worry about the fundamentals, when you worry about economic strength, those expectations start to kind of shift as well, and we demand more. We saw just a very, very modest move higher and already settled back down. And even in that modest move higher, that spread, Adam, was historically quite low.
Yeah, and it's interesting where it finished the week, where junk bonds ended up rallying through the end of the week. But the reason why we're talking about this in junk bonds is in part because junk bonds represent debt in businesses that they're surviving. They're not thriving. And if we get any economic weakness, any credible threat of economic weakness or a recession, junk bonds would explode and they would look out below, so to speak. And we didn't have that this past week. They widened a little bit, but it wasn't just a huge blowout as if there were a legitimate concern of a recession on the horizon. And it's good to see through the rest of the week, junk bonds actually did rally into the close.
Yeah, they did, and I think, the fun part of junk bonds is always that little extra juice, that little extra yield you get from owning businesses, to your point, that aren't thriving. The downside is that when they struggle, they look like stocks, not like bonds. And so if you're not getting paid to take that risk, as you really aren't right now, it's one more reason why we are so focused on quality. John, maybe one big selling point of the start of this week was younger investors, right? Looking at opportunities that emerge in those kinds of market sell-offs. I know you deal with a lot of younger investors. Are you having conversations with them perhaps about, maybe now's a good time to put some cash to work, not just, run for the exits?
Yeah, and that's actually a conversation that I try to go out of my way to have with younger investors, is seeing, Kendall and I were actually talking about this today, is training and talking about seeing the market going down as an opportunity more than it is a negative. When you have a long time horizon and a lot of runway, that's looking at a discount. It's not looking at something that's, oh no, the world is ending when the market drops a few percent. That's an opportunity.
Yeah, and I guess an opportunity for all investors, right? Not just for the younger ones, because if you had proper allocation leading up to that sell-off, right? And we got intraday almost a 10% swing in the S&P 500. Didn't hit the technical correction, definitely on a kind of close-to-close perspective, not there. But it was a big move, and yeah, things are still a little expensive, but no matter who you are, if you had some cash to put to work, you got a better deal on Tuesday than you did last week, Thursday.
Yeah, for younger investors, this is true for everybody. Through the volatility that we've seen in those downturns, we think of it initially as like, oh, this is a risk today. But then you get removed a few years in the future and you look back and go, oh, that wasn't a risk. That was an opportunity. And you just have to train yourself that when the market is down, the best thing to do, well, maybe for one, turn off the TV. The second best thing to do is to get out the checkbook and buy back in and buy more at lower prices. Just some food for thought.
No, I think that's good advice, Joel. We got just a couple of pieces of meaningful economic news this week. One of the trends that has started to develop, at least with these economic releases, is that good news tends to be good again and bad news tends to be bad. I think as we get more clarity on the Fed's direction, maybe we can finally take some of these economic reports at face value.
Yeah, John and I were talking about this earlier today about how there is more attention to these economic reports, but sometimes the attention is on the wrong aspect of the report, because we both saw things that said that a lot of the upside of the market on Thursday was because of optimistic, drop in unemployment claim numbers. Well, they were the unemployment claims for the latest week, which I never look at those. I always look at the 4-week moving average, because it's so volatile week to week that's a smoother way of looking at those numbers. If you look at the 4-week moving average, it's the highest it's been in 13 months. I mean, it's that number has been looking increasingly worse week to week. The last 9 weeks, that number has gone up. So, but again, putting it in a bigger perspective, that number's 34% below the average since 1967 when they started keeping track of that. So it's still in a historically tight hiring market, and that's a good thing for the economy. The labor market is pretty sound. We know that there's more talk in the last week or so of are we going to be in a recession? Are we in a recession? The panel of economists who are the National Bureau of Economic Research, three main things that they look at when they're determining, because they're the ones who actually technically determine whether something's in a recession. They look at personal spending, personal income, and job growth. And so those job numbers that we saw last week that spooked the market, those are actually okay because it was growth. We had 144,000 jobs, and it was just that the analysts were expecting 175,000. The numbers this Thursday, even though the weekly number looked good because the unemployment claims were down, if you look at the bigger number, the longer take on it, it's still a good job market.
I think so. And, when you talk about kind of economic forecasts and economic projections, the Atlanta Fed puts out kind of a more forward-looking projection for the quarter. Their numbers were so rosy, it's probably not even worth mentioning the specific, other than to say it is not a market in which the people that look at this stuff every day are saying recession is here. They're certainly saying the economy is slowing. They're certainly saying, hey, we got to watch these things. But, even when you look at kind of the current data and not just going back to what happened in Q2, what happened in Q1, we're talking about an economy that's still growing at a pretty slow pace. The ISM Services Index out early in the week. The service sector is such a big part of our economy now and showing signs of economic growth there.
Yes, the last 3 months that was showing, 2 out of the last 3 months that was showing contraction in the service sector, and this latest report signaled expansion, and it's actually been mostly expansion since the recession that was triggered by the COVID shutdown back in 2020, and that's a survey-based index that the Institute for Supply Management does, and a lot of the supply managers they were talking to were saying that they had a wait-and-see outlook. And that they were kind of holding back because they're still seeing high prices and they're still waiting to see what happens with the election. They're concerned about the tariffs in particular, but most of those who were surveyed said that they're seeing flat or slowly growing business activity, and that's good.
It's absolutely good. I think when you kind of put it all together, it tells the story. I feel like a year or 18 months ago, we said this is the goal, right? This is what the Fed is trying to accomplish. We're now in the middle of the economic environment in which maybe the Fed actually has done what they said they were going to do. Definitely too soon to say how far it goes, but certainly fair to say that if nothing else, they've gotten to the point now where they can have the next conversation on what do we do different going forward.
Yeah, and the Fed's goal, this whole point, was to cool off an overheating economy and to slow us down, and they've gotten their way. We've had our bumps along the way, but we are slowing. And I know I've gave this analogy before, but I'll use it once more just because it helps to put all this in context and perspective. But, like on a road trip, you've been driving on the freeway for hours at a time and maybe 75 miles an hour, and all of a sudden traffic starts to slow down, and you ask yourself the question, well, why are we slowing down? Is it because there's an accident up ahead, or is it because we've reached our destination? And I think as the Federal Reserve is concerned, they've reached their destination thereabouts, and you would expect us to slow down and take city streets from here. We don't need to be on the highway anymore.
I actually wrote down this quote for you, Adam, but I saw a former Treasury economist who was quoted in a story about the economy today, talking about how difficult it's going to be for the Fed to figure out whether it's a soft landing or whether, so they're trying to slow this without causing some instability. And she said, it's very hard to distinguish the difference between reaching the runway and plowing through it.
Well, and of course, don't envy the Fed's job of driving down the highway at 75 when you're doing it always staring out the rearview mirror, right? And so I think we have to remember that for all that the Fed faces in terms of getting knocked down by presidential candidates, for all the Fed faces in terms of having to go to a dinner party with their wives and hearing from all their neighbors about how terrible of a job they've done navigating inflation, they're working with data that often is months old and with tools that aren't going to show an impact for months to come. And so it is not an enviable job. It doesn't mean that we should give them that much grace. But I do think when we talk about kind of direction versus how perfect were they in executing the strategy, they've gotten the direction right so far. Yeah, it hasn't been perfect, but let's give them just a touch of leeway here in navigating this next phase of kind of the economic environment.
Because they have been able to navigate the first phase with cooling off an overheating economy without upsetting the job market and without putting us into a recession. And as an economist myself, I'm the first to acknowledge how difficult of a job that was. So far, they've been able to do it.
Let's hope they get the last part right. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.